I want to welcome in Torsten Slok. He's partner and chief economist at Apollo. He's here with us at Post 9. It's good to see you. Welcome to our program.
Thanks for having me.
What does pretend Fed President Slok do in September? What would your vote be?
Well, the challenge here is that the dual mandate is, of course, very torn. On the one hand, inflation is going up, as we saw in the PPI data. And when inflation is going up, the Fed should be hiking. On the other hand, the employment report for July was very weak, which says the Fed should be cutting. So where do they want to put the weight in the dual mandate? Do they put more weight on inflation having gone up more recently? Or do they want to put more weight on growth slowing down? The dot plot is telling you, and that would be my vote, that they should be cutting. The dot plot is telling you that we are expecting cuts to come along over the next several years. But the question is, as Steve is saying, how quickly is that coming, and at what magnitude should we expect that for the rest of this year?
So to make sure I understand, I mean, the bottom line of what you just said is that you think they should be cutting. Why aren't more Fed officials coming out more publicly and more forthcoming towards that perspective?
Because I think that they are putting more weight on this inflation risk, that there's simply more inflation in the pipeline coming from PPI being so strong. And when pipeline inflation is high, it ultimately translates into higher consumer prices.
Steve, you know, I thought we had moved from believing that they were going to be more concerned about inflation being sticky to erring on the side of labor market caution. And if there was any fallout there, that they would cut rates. Mr. Slok next to me here suggests we may have moved the needle on that a bit.
First of all, I thought you put Torsten on the list. Maybe now he's the 12th candidate when you asked him what Fed Chair Torsten Slok would do.
Pretend.
I don't know if you have the power to do that, but you might, Scott. You're pretty influential. Listen, I feel like if folks were paying attention, they weren't sure about the move that you just characterized there, Scott. Yeah, the big revisions were a big deal, but we did do 73,000 in the month of July, and that may be the right run rate here. And nothing has really clarified, especially on the inflation side. I feel like the market talked itself into something without really listening to the Fed. They thought they had 2 votes, but they didn't go to figure out if they had 10 more. And I'm telling you, I can't tell you if you have another. What do you need? You need 5 more votes. I'm not sure you have it. And I made a point in my presentation, Scott, earlier saying Powell hasn't spoken. That's really important because I think that there are those on the committee ready to back the chair for the sake of backing the chair and because they agree with him. And they're waiting to hear. You know, Musalem, he sounds pretty hawkish to me. Schmidt, pretty hawkish to me. That's 2 votes right there against. I'm not sure where Jay Powell is. I will tell you one thing, and I'm interested in Torsten's thought on this. Jay Powell promised us one thing. He promised he would leave as Paul Volcker, not as Arthur Burns. And I believe in that promise from him, and that he's going to work till his last day to make sure he doesn't leave with inflation.
How would you respond to that?
Well, 1 year ahead inflation swaps today are trading at 3.3%. That's telling you that the market is already today pricing that inflation in 1 year's time will be way above the Fed's 2% target. So that's why this very tense debate on the FOMC is so critical at the moment. And I totally agree with Steve. What Powell says next week is absolutely critical. We could get a very difficult situation with a significant amount of dissents on the committee in the September meeting. And that would be, of course, very unusual. We already had 2 dissents at the last meeting. And if we start to have 3, 4, 5 dissents, then the committee will look very torn by any measure from a historical perspective.
Well, it's funny you bring that up because that's where I wanted to go to next. You already have 2 influential dissents, Fed governors. Right? With respect to presidents, it maybe carries a little more weight when a couple of Fed governors are the ones who are dissenting. It was the first time in like 3 decades that you had that scenario. Chair Powell doesn't want to be put in the position where it starts to look bad, where he's the one leading the charge, pushing back against the dissenters.
Exactly, because his job is to create consensus on the committee. His job is to corral everyone together and say, this is our view. And I go out to the press conferences and I talk about that view. If you now get to a situation with 3 dissents, maybe 4 dissents, it will be a very difficult press conference because then people will begin to say, well, that's your view. What do you think about the dissenters? What is their representation of this view at the press conference? That's why this dissent issue is really, really important. And we haven't seen this for a very, very long time.
How are you thinking about that, Steve? Chair Powell doesn't want this to get ugly.
He does not. I will say this. My thinking is sort of changing as I'm listening to Torsten, as it often does when I read his reports. I had thought it was possible for Powell to go into next week and really not give us an economic outlook, disappointing almost everyone out there. I think we've reached a point where he may not be able to do that anymore. I think he does need to provide at least some interim guidance and give us some reaction. The events that have happened over the past month have been important. The market has taken some pretty strong stands. And if he's thinking no cut, I think he needs to provide some guidance to the market to that effect. If he's thinking cut, then okay. And whether or not it's one cut or two cuts. It is interesting, Scott, to see how much the market has backed off. I don't know if you remember me coming on your show and saying, Scott, it's 3 cuts now. And now it's down to kind of barely 2, right? We do have that second cut built in, but it was September, October, December. Now it's September with some doubt and December with some doubt. So they backed off a little bit. And I think some of the effect of the talk that the Fed talk this week has been to kind of ease off the markets. And it took them a couple days, but the market's now listening.
You put a note out this morning, Torsten, which has gotten some play, looking at the price action in FedEx shares. Is that suggestive to you that the economy is going to go through some sort of trade-related slowdown globally?
Well, and that's, of course, what we're all monitoring so carefully. But the risk, of course, is when you have a trade war, we shouldn't really be surprised if trade starts to slow down. So that's why the quantification of that risk is incredibly important. Namely, is that quantification so big that it ultimately ends up slowing things? If you look at the Yale Budget Lab, they have a simulation of asking what are the implications of raising the effective tariff rate from 3% to 18%, and they only show that the GDP goes down by 0.7, so not a recession. But to answer your question, I think it's a very, very critical debate for markets. Namely, if there is a sharper slowdown coming, especially, of course, in trade, it does raise more significant downside risk to the growth side of the Fed's dual mandate.
I appreciate you so very much coming here, Torsten. Thank you, Torsten.